Welcome to Cafe Mutual YouTube channel. Friends, many experts believe that large cap stocks are reasonably valued compared to mid and small cap segment. While we will get the answer to this question, Nippon India has recently launched a new large cap index or ETF called Nippon India Sensex Next 30 Index Fund, an ETF. So to talk more about this fund, today we have with us Arun Sundaresan, Head ETF Nippon India Mutual Fund. Arun has over 2 decades of experience in product management, sales, and distribution. Welcome to the show, Arun.
Thank you, Nisha. Pleasure being in the show.
Arun, over the last 5 years, the equity markets have not seen any significant correction. But historical data suggests that equity markets tend to experience a major correction every 5 years. At the same time, the Indian economy is one of the fastest growing in the world. In fact, today it is one of the fourth largest economy. So, considering these two contrasting data points, what is your outlook on the equity markets?
Sure. So, Nishant, actually from end of September 2024 till about the start of April 25, we did see some meaningful correction. On the benefit of hindsight, we know the numbers. Like, for example, from the peak to the bottom, frontline indices like Sensex Nifty corrected almost by 18-20%. And mid caps, small caps, and some part of the market actually fell by 30%. So that's a reasonably sharp correction if you're alluding to correction happening from time to time. Now, the reasons for that correction, again, with the benefit of hindsight, we know that there are a lot of uncertainties looming at that point in time, particularly with the new president coming in. What could be the policies? Could there be any tariff related global economy related issues and so on and so forth primarily, and other things like geopolitical tensions going on in the world. Combined with the fact that valuations of the market, particularly the Indian market valuations also were quite high at that point in time. But since then, things have improved, at least temporarily right now, for the last month or so, particularly from April 7, after a few days from the Liberation Day, where initially there was this big tariff war going on. Each country, particularly the US, imposing very, very high tariffs on other countries like China, Europe, and including countries like India. And China again retorting back with high tariffs. That was intensely going on, leading to a lot of concerns. But since then, at least temporarily, a lot of things have been kind of put on hold. A few things have been rolled back, and the tone has softened, giving hope to the point that maybe things will be a lot better even as we move forward, and many countries would be able to find solutions through the bilateral trade agreements. On the other hand, we also had geopolitical tension in India. Luckily, it soon kind of cooled off. That also gave a lot of confidence to the market. There are a lot of near-term positives. Interest rate cuts have been that started coming from the RBI side. The liquidity regime is fairly okay. Therefore, while these are near-term positives for the market, in the fundamental side, the long term, as you rightly pointed out, India has just become the fourth largest economy in the world. We are amongst the fastest growing large economies, growing at a reasonably good GDP growth, and aided by a lot of near-term economic indicators, be it a good GST collection, high PMIs, the purchasing manufacturing index, whether it is for on the good side or on the services side, all these numbers are showing good uptick. With the market corrections, our valuations also have become slightly okay. The corporate earnings, which have been slightly weak over three, 4 quarters now, the base effect is starting to kick in, and from here on, there is a belief, there is a hope that the corporate earnings also will start looking good. So therefore, from a fundamental point of view, a lot of things are in place. The budget announcement where tax slabs were tweaked, that also gives a lot of money at the hands of investors. and this is a year-on-year phenomenon. It's not a one-time rollout. So that will eventually, some part of it will be spent, some will find its way into the capital markets also through savings. All of these things are positives. Monsoon is expected to be good. Government continues this capex spending. So a lot of these fundamental things are looking good as far as markets are concerned. So we remain optimistic as far as India is concerned. Valuation was a joker in the pack, but to that extent, with this correction, although there has been some pullback, we are at a reasonably much better place than what we were on hindsight, 7 or 8 months back.
Great, great, great. So talking about the valuation, so many experts believe that the large cap stocks are reasonably valued, while mid and small cap appears overvalued. So what is your perspective on the valuation of these market segments?
See, Nishant, if you look at the trailing P,
Hmm.
which is the past P, markets actually don't go only by that. There is a lot of hope when market trades at whatever levels in different parts of the market. One is, the past, which is known to everyone. The other part is what you expect to happen in the different parts of the market. So
Hmm.
therefore, you cannot go only by the valuations, the trailing PE, etc. It gets combined with lot many other factors. But having said that, if you were to purely go by an objective number, which is the trailing P, which is in fact some of the strong data which is available, which is the proof. When you look at frontline indices, the large cap indices like Nifty, Sensex, etc., they are trailing P is close to about 21, 22. Whereas mid caps and small cap, that number is somewhere around mid cap, for example, is 34 and small cap is something like 30. So
Hmm.
therefore, if you make a direct comparison from that point of view, the large caps appear to be, when compared to mid caps and small caps, relatively better placed, which is in a way true. Large caps also have, because the nature of the companies in large cap, these are well-established companies. They've been growing their earnings steadily. The return on equity, the ROE of these companies are actually good. In fact, even better than the mid cap and the small cap pack. And this is also coming to you at a PE when compared to mid caps and small caps at a lower valuation. Therefore, it gives that impression that large caps are better placed. But however, that may not be the only variable. A lot of things also have to be kind of anticipated. And therefore, sometimes despite this valuation, some part of the market can behave differently. So only time will answer that. But yes, right now, purely going by at least some past metrics like the trailing PE, the large caps appear to be better valued than mid caps and small caps.
Okay. So Arun, what is the rationale behind launching the Nippon India Sensex Next 30 Index Fund and ETF? And how is this fund different from a plain vanilla large cap index or any large cap ETFs?
So Nishant, we are launching the same on the funds on the same index in two different variants.
Mm,
One is the ETF and the other one is the index fund
mm,
variant. So the index fund is called Nippon India Sensex Next 30 Index Fund, and the ETF is called Nippon India Sensex Next 30 ETF. So these are two different variants, but on the same index. Now, what is this index all about? Like the name itself suggests, it invests into Sensex Next 30. So, as all of us would be aware about, Sensex is the top 30 companies in India by free float
mm,
market cap. So, this particular index is Next 30. So, it ignores the top 30. It leaves that Sensex 30 stocks away and instead invest into stock numbers 31 to 60. So therefore, what happens is that the portfolio you get, the exposures you get, whether it is in terms of the
mm,
sector exposures, whether it is in terms of the actual stocks, etc., the portfolio is very distinct and unique from generally what you will have. Now, whether it is Sensex, Nifty, or any large cap exposure, if you really look at it, these are all broad-based market cap-based indices like Sensex or Nifty, which means that the larger sized companies by way of free float market cap, they have higher weights, right? So invariably, the large stocks, and usually they'll be part of Sensex or Nifty, they tend to dominate the portfolio, right? Whereas the stocks which are in the later part of the large cap, in this case, maybe the 31st to the 60 stocks or, thereafter, etc., they usually have a lesser weight in a typical portfolio. Therefore, by investing into this product, fund, your exposure when compared to not only if you have passive exposure to Sensex or Nifty, or for that matter, even your active large cap funds, this particular portfolio will be very, very different when compared to your usual portfolios. So that's the value addition, this particular fund brings to the table.
Okay. So Arun, we have gone through the index. So we have found that just three sectors contribute 40% of the total allocation in the underlying index. So why don't you think that the index is a little concentrated?
Actually, Nishant, all frontline indices like Sensex, Nifty, as
Hmm.
I mentioned, they're all market cap based indices, right? Therefore, the larger stocks have a higher weight in those indices. This is the case with all market cap based indices, even mid cap, small cap indices. Small cap, for example, it might have 250 stocks, but the top stocks in small cap will have much, much higher weight than the stocks towards the tail, right? So this is how it is, and therefore you'll have to see concentration in relative terms. Sensex, for example, the top three sectors account for 60%. Nifty, the top three sectors account for 50%. Not only that, if you look at Sensex, for example, there are three stocks. In fact, the number one stock has a weight of 15%, and there are two stocks which have a weight of 10% each.
Hmm.
On the other hand, this particular fund, one when compared to Sensex, where top three sectors are 60%, here it is 40. That's point number one. Second is even the topmost stock here has a weight of less than 5%. So the fund actually has diversified exposure to 12 different sectors. And within that, even the top stock is less than 5%. This vis-a-vis Sensex or Nifty, where the top stock could be 13-15%, and there are a few stocks which have weight of something like 10%, 9-8%, etc. So to that extent, both in terms of sector exposure as well as in terms of stock exposure, this is far more diversified. And the other point to note is that the portfolios I did mention will be very, very unique. Just to let you know, Sensex has almost 40% exposure to banks and financial services. Out of that, almost 37% is banks.
Hmm.
This particular fund or the index has no exposure to banks at all. There is zero bank. Now,
Hmm.
I'm not saying that not having any bank is a good point. I'm only pointing out the difference. So even though this is large cap, even though all of these are subsets of BSE 100 or the large cap universe, you see the difference where by investing in a Sensex or Nifty, essentially what you're doing is investing into 5, 6 banks, having a cumulative exposure of 35 or little less, little more of bank, whereas here you do not have bank exposure at all.
Hmm.
And therefore, the point I'm making is the portfolios are very, very different. Whether
Hmm.
it might look like it's a financial services exposure. Not only are the exposures different, but the actual stocks and their weightages also are very different,
Hmm.
bringing a unique portfolio to your table, helping you diversify. So
Hmm.
that's the key point that investors need to keep in mind. In fact, this particular portfolio, when compared to Nifty 50, you might think that there are 20 stocks which are similar, right?
Hmm.
But the overlap is only 14%, 1/4. It's
Hmm.
only 14%. Even with the next 50, the Nifty next 50, the
Okay.
overlap is only 33%. sorry, 32%. So 68% is different, right? So, and obviously with Sensex, that's no overlap. So therefore, you take this portfolio, compare it with Nifty Next 50, or for that matter, even with any active large cap fund, you will most likely see 14, 15, possibly maximum 20% kind of overlap, which means that this fund, the exposure you will get will be very different, complementing your within large cap, your existing portfolio also. This will help you diversify.
Hmm. Great, great, great. So, so this is the new index, but how has the fund performed in the back testing?
So the index data is available from 2014. So we have 11 years data.
Hmm.
So obviously you can do analysis in a lot of ways. Since that time, how much is it given? Year on year, what is it given? Or today, point to point, what is the CAGR?
Hmm.
But more interestingly, we look at rolling returns.
Hmm.
From 2014, if you had invested for the last 11 years at any point in time, and you kept it for 3 years,
Hmm.
what is the average 3-year return? How does it compare with, let's say, Sensex, Nifty, or Next 50?
Hmm.
What we noticed was that this particular index for this time frame and this comparison had the best return profile. In fact, the 3-year average return worked out to something like 14.5%, which when compared to Sensex, Nifty, or Next 50 was 50 to 90 basis point higher
Hmm.
per annum CAGR on a 3-year rolling basis. That's the kind of return difference that this particular index had exhibited. This is on rolling year data. For the last 11 years, this is outperformed Sensex in 8 years, only in 3 years. And which are these 3 years? 2018, 2019, and 2020. Except for 3 years, it had outperformed in all the years. And
Hmm.
on hindsight, that 2018 and 2019 were very exceptional years where, there was market narrowness.
Hmm.
Very, very few number of stocks actually did well. If you remember, there was a acronym called as HRITIC, that HDFC, Reliance, ITC, and a few stocks, only they did well. And the entire, forget about Sensex or large cap, within the entire market, only a few set of stocks did well. It
Hmm.
was during that period of 2018 and 19, and obviously 2020 was COVID year. It looks like 3 long years, but more exceptional than otherwise. But otherwise, in the last 11 years, every year, this has actually outperformed. And in the last 11 years, if you looked at the calendar year return, this
Hmm.
particular fund had outperformed Sensex by, on an average, 2.7%,
Hmm.
including those 3 years where it underperformed. So all the 11 years put together, this is outperformed by something like 2.7% on a calendar year basis.
Got it, got it. One last question, Arun. Why should MFDs recommend a Nippon India Sensex 30 index fund or ETF to their client?
So simple, see, large cap, generally in the active side, you will only have one variant. Each fund house will have only one large cap fund.
Hmm.
So your investors might have invested in large cap funds, but in general, if you look at the portfolios, you will have the usual set of stocks and similar weights. You cannot escape not having, let's say, the frontline banks, like it could be HDFC Bank, ICICI Bank, or RAL, or ITCs, and so on and so forth. So there will be a lot of overlap. In fact, even though you may think that you have 4 or 5 different large caps, or for that matter, I've already invested in Nifty. Why should I invest into this particular large cap offering? How is it different? As I mentioned, this will be very, very different whether you compare it with any other passive offering or active offering. My sense is you may have 15, 20, or at most maybe 20-25% kind of overlap. Therefore, within large cap, if you are a proponent saying that large caps are looking attractive, maybe now contextually, or from a fundamental perspective, you want to take exposure to large caps for the longer term, and you're looking at diversification within that space. So this is a very good offering in the sense that the portfolio, the exposures are going to be very, very different. Again, past returns are no indication of future, but The past return profile also suggests that this is a portfolio this is a strategy which is done relatively better even when compared to other large cap strategies. Therefore, our partners can look at it from bringing a new product which can help them diversify, will complement their mutual fund portfolio in general, even the large cap portfolios in particular.
Great. So it will complement the large cap portfolio of the client. Okay. So all right, Arun. So we have come to an end to this interesting session. Thank you so much for your valuable time and inputs.
Thank you very much, Nishant.
And finally, I thank each one of you. Have a great day at work, guys. Bye.